Hello and welcome back to yet another video. I hope you are all doing well. In this video, I'm going to answer the question, what is going on in the property market and is now a good time to buy and sell a property? So, let's get into it. Ever since the stormy clouds of the 2008 financial crisis have cleared, the property market has been in a state of euphoria, reaching new all-time highs year after year, largely thanks to the super low interest rates and the various home buyer incentives. But to understand if now really is a good time to buy or sell a property, we need to take a little trip down memory lane. Starting in the early 1990s. The decline in this instance was caused by drastic interest rate hikes geared at squeezing out high inflation. This in turn sparked a deep recession which lasted 5 quarters from Q3 of 1990, and house prices fell 12.3% by the time they bottomed out in October 1991. Then we had the global financial crisis, which caused a credit crunch that then caused a massive reduction in the availability of mortgages. Approvals fell by more than 75% peak to trough, and mortgage availability was constrained at the riskier end of the market, leading to a sharp decline in the proportion of mortgages granted on the higher loan-to-value ratios. The volume of housing sales also fell pretty sharply, halving between 2007 and 2009. Between their peak in September 2007 and their low in March 2009, UK house prices saw a decline of 18.8%, pretty much across the board. In contrast, the pandemic doesn't really even compare. There was a temporary delay in moves due to restrictions on viewings, but prices soon rallied on the back of monetary and fiscal stimulus. Take for example the stamp duty holiday, which helped keep the property market afloat during the height of the pandemic. But that came at a cost, and that cost was £6.4 billion for the Treasury. But the stamp duty holiday didn't just keep the market afloat and cost the government billions. You see, it actually compressed what would have been multi-year growth down into a matter of months. And we saw property prices increase an enormous 10.8% in 2021, the fastest annual rate of growth for 14 years. Now, as a property owner, I can't lie, it's been a wonderful thing to be a part of. But it appears as though the tide might be changing, and we may be transitioning from what has been a seller's market to a buyer's market. So why do I think this? Well, of course there are higher interest rates, which I will come on to shortly, but before I do, there is some data that we need to consider first, and it comes from Zoopla. So, according to Zoopla, home buyer demand fell by 50% in the last 3 months of 2022, and the number of sales agreed was also down by 28% year on year. This data has now also been mirrored by Propertymark, the leading professional body for estate agents, with its latest figures showing the number of prospective buyers registering with agents falling from 2.5 per available property in December 2021 to 1.4 per property in December 2022, marking a pretty substantial decline of 45% year on year. And if that wasn't enough, Propertymark also reported the average number of viewings per property fell 71% between April and December 2022, which actually correlates with the increase in interest rates, which can be seen by this graph. There is also estimated to be 1.8 million borrowers that will have to move onto a new fixed rate mortgage in 2023, the majority of which are going to face significant increases in their monthly mortgage payments, and that's not even considering the cost of living, which has also gone up. And this now brings me onto the issue of interest rates. Now, interest rates are not the be-all and end-all when it comes to the property market and whether it goes up and down. But housing prices do directly correlate with mortgage rates. What underlies both is the health of the overall economy. But the reason I want to specifically focus on interest rates is because they affect so many parts of the property market, like capital flows, supply and demand for capital, and an investor's required rate of return. So rates are really a driving force behind the property market. Now, conventional wisdom is that rising interest rates make buying or selling a home more difficult, and decreasing interest rates make buying and selling a home easier. To illustrate this, I'm going to use a really simple example. But before I do, please remember to like and subscribe and let me know in the comments what your thoughts are on where the property market is heading. Also, don't forget to check out my newsletter, Business Bites, A link for that is in the description. Okay, now back to the video. So let's first take a look at how interest rates impact home buyers. When mortgage rates increase, affordability decreases. So Dave the home buyer wants to qualify for a £400,000 mortgage at a 4% interest rate. But at 5% interest, banks and building societies can only offer Dave a loan of £355,000. A single 1% increase in mortgage interest has decreased Dave's purchasing power by £45,000. This, of course, has a knock-on effect on the guys who are selling their properties. So, to continue on with this example, the seller of the home that Dave wants to buy, let's call her Julie. Julie can, of course, list her home at £400,000. But because of rising interest rates, Dave and many other potential buyers can only afford to buy her house at £355,000. So you can see how a 1% increase in mortgage interest rate has completely wiped out £45,000 on the market value of Julie's home. Now it's important to remember that historically speaking, we are still at very, very low interest rates. For example, in the 1970s, rates hit 17% because rising wages and oil prices were causing a surge in inflation. There were also the very high rates in the early 90s when they averaged around 15%. But if we average all of that out, from 1995 to 2022, the average mortgage interest rate in the UK has been about 5.62%. So although rates seem extremely high now, they actually aren't. The problem is we've become accustomed to super low rates, so any increase was always going to seem a bigger deal than maybe it actually is. The other thing we have to consider, of course, is price to income ratios, which are at record highs. And according to the ONS, full-time employees can typically expect to spend around about 9.1 times their workplace-based annual earnings on purchasing a home in the UK. Previously, 8 times earnings, so not even the 9 times we have now, had only been breached twice in the past 120 years. Once just prior to the start of the financial crisis, and once around the start of the 20th century. So, circling back round to the big question, is now a good time to buy and sell property? In my opinion, the answer is yes to buying and maybe to selling. Without knowing specific situations, I can't say 100% if now is a good time. I can only give you my opinion based on what I would do. In terms of selling, unless I needed to sell a home as a matter of urgency, for example because I needed the cash for an investment opportunity, or to raise equity, or to upsize, then in general I would probably choose to hold off until there was a more positive sentiment towards the market. Prices are starting to come down in line with interest rates. So if you need to sell a home and you wanted to increase your chances of getting the best possible price, I would probably try and front run. So basically what I mean by that is underprice my home slightly to just above where I think house prices are going in the next few months. That way you don't get caught out by having to reduce the price as prices are falling, you can get ahead of them. And in terms of buying, my personal opinion is it's better to buy property and wait than to wait to buy property. There are always going to be fluctuations in the market. Prices are always going to go up and down. As long as you plan to buy and hold, I don't think you need to worry too much about the short-term fluctuations in the market. Quick example of why I think this. If you had bought a home in January 2007 and sold in 2010 at any point, then your home would have roughly lost about 5% of its value. But if instead you had held the property until today, based on the average property price data held by the Land Registry, your property would now be worth 66.8% more today than when you bought it. So it really is better to buy and hold property if you can. So there we have it. I hope you found this video useful. If you did, remember to subscribe to the channel for more videos just like this one. And of course, go and subscribe to Business Bites, my newsletter, and join our growing tribe of investors. Thank you for watching. Until next time,